Netflix shares under some pressure this morning. Profits actually topping expectations, while revenue fell a little bit short of estimates. The streamer saw an uptick in subscriber numbers as it expanded its password crackdown and is also poised to be able to perform well while writers and actors are on strike in the United States because of its extensive international productions, at least relative to the other studios. Joining us right now to discuss more is Tom Rogers. He's former NBC Cable president, former TiVo CEO, and a CNBC contributor. And Tom, what do you think? The conventional wisdom is that, Netflix will do okay, at least for a while, compared to the others. Is that your take on it, too?
Yeah, that's absolutely my take. But, excuse me, let's step back a minute. Contrast that earnings call with the Iger interview with David Faber last week. And it's night and day. You're talking about a company with Netflix that just doesn't have to deal with the burden of decline and what happens when your current business model is thrown up in the air and you have to recreate a new one. This was all forward-looking. It was about accelerating revenue. It was about increasing margin, increasing cash flow. It was all about growth. And you can really contrast that with the very difficult situation of the legacy media companies, made worse by the strike, as you say.
If you look at a longer-term stock chart of Netflix, guys, if you can pull it out for a couple of years so we see that. Tom, there were some serious questions about Netflix business model not too long ago. Look at 2022 when it went from $700 down to $150. That was the thought that all of a sudden you were not going to be able to pay for growth at any cost, that investors didn't want that anymore. So how much of this is sentiment and how much of this is for real numbers? And I understand not having the declining legacy assets, but, stock market can do things to these companies, too.
Well, I didn't have any question about the Netflix model. Obviously, as you know, on this show, I pointed out the problems on the legacy side for a long time, even as those stocks were doing much better. I think the view here on Netflix was that they had let a problem grow well beyond that they should have, with 100 million viewers around the globe taking the product for free. And they finally decided to crack down. And I think the headline coming out of that is the crackdown had a lot less noise to it than many people expected, meaning it's implemented. There isn't a huge amount of pushback. They obviously got a lot more subs out of that than people thought they would at first. And with that, to Joe's point, hey, is this a one-time phenomena? Or is this something that's recurring? What you got to remember about streaming services is that they all have a lot of churn. Netflix, a lot less churn every month than most, but still on an annual basis, close to 25% of subscribers come off. But they do come back when they want to watch something. And now when they come back, that low-cost ad-free tier at $9.99 isn't going to be there for them. And so the thinking is that they're going to come into the ad tier. And the ad tier, because of the additional ad revenue that comes with it, has a lot more revenue behind it. And so there's something going here that looks like they can really grow revenue substantially. Yeah. And that's something that the other guys can't easily point to.
Tom, really quickly, we've got like 30 seconds. What you said, 25% of all the streaming services come off annually. People come back when they want to see something. That's a big deal if you don't have any new content because you're involved in a strike for all of them.
Well, the churn for the other services is much higher than Netflix. That's more or less a Netflix churn number. But remember, and MoffettNathanson made a great point on this recently, if you took just Netflix viewing of acquired programming, not the original productions, but acquired, it would still be the most viewed streaming service. Think about that, just on their acquired licensed programming. And all the other guys are looking to license more of their programming to others and not hold it for themselves as they deal with their own cash flow issues. So Netflix is going to have even more product to acquire and to be able to do it at a cheaper price. And with that, I don't think Netflix is going to really have that much difficulty here compared to the other services.